You just got a pre-approved credit card offer. For a second, you feel special. Then you panic. Did they just check my credit? Is my score about to drop? Before you shred that letter, let's talk about what's really going on. These are soft pulls, and they are completely different from the credit checks you actually need to worry about. Whenever someone looks at your credit, it's an inquiry. But there are two types: soft pulls and hard pulls. Think of a soft pull as a casual glance at your credit. A hard pull is the full, in-depth investigation that happens when you're officially asking to borrow money. The biggest difference is how they affect your score. A soft pull has zero effect. A hard pull, however, can cause a temporary dip, and that's the entire secret. Let's be crystal clear. A soft pull will not lower your credit score. All major credit bureaus and scoring models like FICO and VantageScore agree on this because they don't include soft inquiries when calculating your score. A soft pull doesn't signal that you're about to take on new debt, so it isn't seen as a risk. That's why you might see soft inquiries on your own credit report, but lenders can't. They're for your eyes only. You've probably had a soft pull on your credit and not even known it. The most common example is when you check your own credit score through a free service or your bank. That's a soft pull, which means you should feel free to monitor your credit as much as you want. And this is exactly why I always recommend using a trusted credit monitoring service. You can check your credit score in just a few minutes, see your full credit report, your FICO score, and even get real-time alerts if anything changes, all without hurting your score. I've put the links in the description if you want to check it out. Those pre-approved credit card and insurance offers are also the result of a soft pull. Even some employers do a soft pull as part of a background check. In all these cases, your score stays exactly where it is. Now for the one to watch: the hard pull, or hard inquiry. This only happens when you give explicit permission as part of a formal application for a mortgage, a car loan, or a new credit card. This is the one that can ding your score, usually by less than 5 points. While a bunch of hard inquiries in a short time can be a red flag, scoring models are smart. If you're rate shopping for a mortgage or auto loan, multiple inquiries in a short window, usually 14 to 45 days, are often grouped together and treated as one. This way, you aren't penalized for being a smart shopper. So, what does this mean for you? First, check your own credit score as often as you like. It's a soft pull and a great financial habit. Second, you can use those pre-approved offers as a risk-free way to see what kind of loans and cards you might qualify for, without taking the hit of a hard inquiry. Third, be strategic with your applications. Try to space out credit card applications, and if you ever spot a hard inquiry you don't recognize, you have the right to dispute it. It could be a mistake or even a sign of identity theft. That pre-approved offer in your mailbox isn't a threat to your credit score. It came from a harmless soft pull. The main thing to remember is simple. Soft pulls are for pre-screening and have zero impact on your score. Hard pulls happen when you apply for credit and are the only inquiries that can temporarily lower your score. Now you can stop worrying and start managing your credit with confidence.